and welcome back to the Financially Simple Experience. So friends, over the last few episodes, we've been diving into this dream of can we build an 8-figure business? Can we build a business that someone is willing to pay us 8 figures, $10 million or more for our business, our practice? We've been specifically talking about the area of financial advisory, specifically my friends, those of you who I talk with regularly throughout the week. I'm actually headed to a conference in a couple of weeks. There'll be just over 1,200 advisors at this conference that I'll be speaking at. And I know that I'll be speaking with many of you who listen to this podcast at that conference. And as I'm talking, rubbing shoulders with financial advisors, I find that their questions as a business owner are not that dissimilar than many other businesses. And so for the last few episodes and the few episodes to come, we're going to be talking specifically around how do we grow the financial advisory business? How do we grow the practice? And can we attain an 8-figure exit? Can we sell a business for 8 figures? The answer is yes. But how do we do it? Today, we want to continue our theme around financial controls. We've looked at 3 or 4 episodes ago that what is a financial control? We talked about perhaps hiring a CFO, whether it be outsourced or insourced, key employee, etc. And then we looked at dissecting to determine what is our most profitable service. Now, friends, if you're not a financial advisor and you own a business, those are the same exact mechanisms and decisions that you can make in your own business at this point. Today, though, I want to take a step further. And I want to deal with this idea of maximizing your business's financial performance with KPIs. I want to give this conversation a theme of insights for my fellow RIA or registered investment advisor owners. It's the title of a business, some sort of financial firm. As many of you know, I own my financial firm for almost 20 years. I've been in the financial world now for about 20 years, and I was a subcontractor or an independent contractor until 2009 when I launched Heritage Investors in 2009, and then sold it in 2022. I think that's right. So I've been in the seat. Not only have I been in the seat as the owner, but I've also been a client-facing financial advisor during this time period. And because we had a business advisory arm, I worked handedly with business owners, helping them drive their net worth, ultimately drive their business value so they could sell their business and meet their dreams. As a financial advisor, one of the things I've learned is that we can implement certain strategies. For example, we could go out and hire a designated CFO. We could hire an internal CFO. We could implement the strategy we spoke about 2 episodes ago. But how do we determine that we made the right decision? How do we judge? How do we measure the return, if you will, on our investment? How do we determine that, hey, the decision I made to move this particular point in my financial front of my business actually yielded the results I desire? The first thing we have to do is we have to know it's important to track financial metrics. It's important to track metrics. Peter Drucker, which I've come to find I love reading his books. He made a statement that he said, what gets measured gets improved. What gets measured gets improved. Now, I believe I can defend that point. I believe that firms that keep accurate measurements can report accurate trends month over month, quarter over quarter, year over year. I believe that is possible. There was a Schwab study that was done between 2016 and 2021, which said that firms that were in that $250 to $500 million of assets under management had 11.5 median growth rate. Now, the numbers for 2022 have not yet been updated. It'll be interesting to see how 2022's market volatility, the declination of the markets, et cetera, have impacted the growth rates of firms. I think it's going to bring that number from around 11.5 down into the 6-7 range personally. That's what I believe will happen, but we'll yet to see. If you're thinking about that number of 11.5, you're automatically examining yourself saying, I'm either doing better or worse than that benchmark. Perhaps you could grow faster than what you're currently growing. Perhaps you could set a trajectory very similar to the J curve that many of us learned in business school. Or maybe you've reached a point in your business, well, look, I don't need to grow at a 13, 14, 20% or meet 40% growth rate year over year. I'm happy with a 8% or a 10% growth rate in the business. That drives the value to where I need it to be. So we know in order to determine could we grow faster, should we grow faster, should we put the brakes on and cool the jets a little bit, slow it down. In order to do that, we have to begin measuring some things. So that enters a KPI or key performance indicator. Now, earlier in the podcast history, I went over a series of podcasts where we talked about key results indicators, performance indicators, key performance indicators, and key results indicators. So I was at that time diving KPIs into my own business, Heritage Investors. I was driving things at that point into my practice, and I was trying to determine what point do I need to measure that will allow me to get the greatest impact to my value of my company. And so I read dozens, I think 20 some odd books within a period of 90 days, books upon books upon books, and found tons of KPIs that we as business owners can track. And then if you dive into each individual market segment, so for example, if you're a tire shop owner, you're going to track a slightly different KPI measurement in your operations than perhaps a financial firm would. So then I begin looking at what are the KPIs that me as the owner of an RIA needs to track. I found tons and tons of KPIs, specifically as it relates to finance. But I'm reminded of a statement that was provided by Bernie Smith, who was the author of one of the books I read called KPI Tracking, Made to Measure KPIs. And what he said was, look, it's best to track 2 to 4 per goal, 2 to 4 KPIs per goal. So if you're going to track 2 to 4 KPIs for your goal, then you need to connect your financial department through your planning department. What specific goal are you trying to achieve right now? And what is the measurement that you're going to use to judge the success of that particular goal? Similarly, there was a TD Ameritrade statement that was provided that said, when it comes to choosing KPIs, less is more. Ideally, you'll just select a handful of KPIs to track. So here I am in my own practice. I'm working with, I think, 10 or 12 employees at the time. Pretty sizable practice by all sense of measurements for East Tennessee. And I'm teaching my team the 8 areas of business, planning, leadership, sales, marketing, people, operations, finance, and legal. I'm teaching them the 8 key areas of business and how they interact with each other and how one particular decision will grossly impact another department. And we identified a handful of KPIs per area. And then we identified a handful of KPIs per initiative that we were trying to utilize. So if we're looking at today's episode is titled, if we're looking to try to maximize our business's financial performance, in other words, we want to see the value of our business increase. We want to try to grow our business where it's at 8-figure value. If we're going to track and focus in on our financial performance, then we need to identify a few financial KPIs that perhaps we might want to consider tracking. So I'm going to give you a list here. Give you a list of KPIs that are pretty common in the financial world, in the accounting world. These should be relatively common terms to us as financial advisors, and even as a business owner. Perhaps you're talking with your CPA and they mention activity ratio. You should know what that means and how it's calculated. So here's a list, and I'm just going to rattle these off and let you think through them. Total revenue, total expenses, gross profit margin, EBITDA, revenue growth month over month. Typically, I would track that on a percentage basis. Profitability ratio, activity ratio, operating profit margin, expense to revenue ratio, EBIT growth, EBOC growth, break-even margin of safety, net profit over tax margin, the current ratio, the quick ratio, operating cash flow, net cash flow margin, operating current cash flow to current liabilities, average revenue per employees, debt to equity ratio, current long-term liabilities, short-term liabilities, which is AP, days of cash on hand, total COGS, total payroll expenses, total payroll to gross profit expenses, profitability per client, revenue per client, stock price increase or decrease per quarter. Or if you're an LLC, it may be unit price increase or decrease per quarter, or membership interest price increase or decrease. That's a handful. That's a handful of KPIs. So now, whenever you look at that term of KPIs, if you don't know how each of those are calculated or what is the makeup to drive that ratio or that particular number, then oftentimes we don't know how to use the data and how to use the data to benefit us and our company. So I would go back through the list. I'm going to give you a handful that you might consider tracking in your initial KPI launch. EBITDA is a major one. EBITDA is a major one. It's going to be made up of many other KPIs. So you can go straight to EBITDA and you can say, hey, what is our EBITDA for this month, for this quarter, for this year? And EBITDA, just for those who just a refresher, stands for earnings before interest, taxes, depreciation, and amortization. Another one you could track if you don't want to track EBITDA for your particular practice, you may track EBIT growth. Or if you're considering a merger, a sale, or something of that nature, EBOC growth is amazing. It's an amazing ratio to track, amazing KPI to track. Another one that I began tracking instantly was average revenue per employee. I wanted to see if I took the 10, 12, 13, 15, however many employees I had at the given time, what my revenue was and how much revenue could I allocate toward each employee. What it did is it gave me a quick ratio, and if the numbers moved up or down over a short period of time, I would know if my company was profiting or moving the direction I need to go to or not. It also gave me an understanding when I need to hire somebody. Debt to equity ratio is one to me that matters because I hate debt. Can't stand it. I lose sleep at night over debt. And so debt to equity ratio is a big one to me. Now, if you're going to do equity ratio, you might as well know what is your current market value. And we could argue all sorts of valuation mechanisms here, but there is a simple methodology you can use. In my practice, what I would do is I would do EBITDA times a multiple. Then I learned that, hey, you can use EBOC times a multiple. And if you can calculate on a monthly basis, then you know, hey, I'm making progress toward my wealth goal, or to close my wealth gap. Profitability per client and revenue per client were some that I instantly began tracking. Because what it allowed me to do is say yes to profitable clients and no to clients that were just going to bring my numbers down. It reaches a certain point where you can't serve everybody. And so whenever I'd have clients that needed help, we would end up shifting them over to a colleague in another firm somewhere that could service that particular client. So there are a number of different KPIs that you can use to track the financial performance of your company. All right. I get that, Justin, but man, that seems like a lot. Yeah, we've got to create a system. Here's step 2, create a system to keep the information. I'm a firm believer in keeping it simple, stupid, because usually I'm the stupid one. I like to keep things super easy. So you want to create a system that's user-friendly. We've got to address the fact that building KPIs, tracking KPIs, examining KPIs is an investment of time and resources. Perhaps it's going to be you, the owner, who's going to track some of these things. Perhaps it's going to be a team effort. Currently, in a company that I'm coaching on, we have almost every employee of the company is required to deliver some KPI on a monthly basis through an automated system. And what it does is it allows the executive of the company, the owner of the company, to determine, hey, who is doing the job? Where are we moving in the right direction in real time? So not only is it going to be time, an investment of time or money, perhaps your time, but it's also potentially be an investment of your team's time. Okay, well, how do you do this? How do you track the KPIs? Well, as I just alluded, in some companies, we can build electronic systems through the CRM, through their operating system. We can build flows that's digitally input by an employee once a month or once a week or once a quarter or once a year. On the other hand, if we're talking specifically around financials, which is where most of us would start, you could use an Excel spreadsheet, get the financials from your accountant, and then figure each of these ratios out. But I learned a software years ago that I implemented in my own practice, and many clients have also adopted this. I'm not a provider or solicitor for them, but most small business owners use QuickBooks, or they use a conjunction of QuickBooks with their accountant's software. If you're using a QuickBooks style software, then there's a plugin called Fathom, 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 which is a KPI reporting program. It costs a little bit of money, but what it does is once you set it up and you set your targets that you're trying to achieve per KPI, it'll provide you, just as soon as the financials are audited or reconciled on a monthly basis, it'll provide you the KPIs in real time. So I'm a firm believer of keeping it simple. And if you're going to start with tracking KPIs, financial KPIs are often the first place we would start. And perhaps you can talk with your internal bookkeeper or your CPA, your accountant, and say, hey, look, I'd love to get these KPIs. I heard of this software called Fathom. Again, I'm not a provider for them. They don't pay me anything to say that. I'm just telling you a tool that I personally have used and that one that I enjoy. It provides a good output. Once you create the system, whether it be internal or external, using a system like a Fathom or using a digital system, perhaps the size of your company would dictate such, next is you've got to get your team involved. Your team needs to understand the KPIs that you're tracking. They need to be motivated to create causality, to create effect on those KPIs. So for example, let's go back to the average household or average revenue per client. If your average revenue per client is $10,000 and you want to grow the value of your company, then it doesn't make sense to bring in another 20 clients that are each providing you $1,000 per household. That could end up causing some constraints within the operations of the employees of your company. So if you know it's an average of $10,000 per client, then you can teach your team that, hey, look, we're trying to bring clients that have an average greater than or equal to $10,000 per client, per household. You see, you can use the KPIs to modify behavior and get your team engaged in what you're trying to build. Another thing you can do is you can give them ownership and tracking. Ownership and tracking, I alluded to this earlier, but ownership promotes alignment and promotes accountability. If you give your team the ability to track a specific KPI and you hold them accountable, then they own it. And that KPI becomes a major bulwark, a major cornerstone in their daily activity. See, a strong KPI system can provide a bottom-down approach and a top-down view for both parties. Oftentimes it's said that we live in an ivory tower, those of us as business owners. I saw a meme this last week that had a bunch of birds sitting on a power line, and they were all the same birds, but you had almost like a hierarchical type of approach. The birds at the top would poop, and it would fall down on the birds beneath them. The birds beneath them would poop, and it would fall down on the birds beneath them. And so when you got 3 rungs down on this picture, the bottom birds were just covered in just white mess. And the caption said, those at the top looking down only see poo. Those on the bottom looking up only see buttholes or they only see negativity, which is the reality of our business. What a KPI does when you get your team involved is allows your team to say, hey, I understand why the owner is making a focus on average revenue per client. Or I understand why the owner is making a focus on revenue per employee. This makes sense to me. We can get in alignment with that. This makes sense on how the owner is thinking. And simultaneously, you as the owner, whenever you're getting feedback from the employees as they're tracking, you can see whether or not they understand how the metric that they're particularly assigned to fits into the greater picture. And it gives you a coaching opportunity to bring your team in an alignment so that you're all marching to the same direction. Friends, it is possible to build an 8-figure practice. It has been done by many, and by many. But if you're going to take a practice from its current size, whatever it is for you personally, and grow it to a size of 8 figures plus, you're going to have to implement the things that businesses who are that size implement. You have to. You can't continue to do the same old thing and just try to say, hey, we're going to sell our way to this value. It doesn't work. It's like putting too much pressure through a water hose. It's eventually going to blow out the water hose. It's not going to be able to hold the pressure. Same thing happens with your team. So if you want to build an 8-figure practice, one of the challenges I'm going to have for you is start with your finance department and identify the KPIs that matter to you, and then implement them throughout your company using software, using teaching, using your team. And in doing so, you're now setting a framework for growth. You're setting a framework to help drive value in your business. You're like, Justin, man, this is amazing. I understand what you're saying, but how do I determine? Hey, look, when you start getting to the specifics of your practice versus perhaps somebody else's, that's where you're going to need a coach. You need somebody who's not familiar with your business. There's a term called familiarity bias. You want somebody who's not familiar with the business that can come in from the outside and see the holes and help you say, hey, you really should be tracking this particular KPI versus this one. And here's why. That's where a good coach comes into play. If you need one, hey, reach out to us. We have a team of financial advisors who are business owners who have succeeded, who have made the ultimate sale. I'd love to have an opportunity to talk with you. Until next time, friends, y'all go out and make it a great day.